Corporate carve-outs are, honestly, they're notoriously complex. But what if we stopped looking at them as just these dry, legal and financial uncouplings? What if instead we viewed them through the lens of a high-stakes relay race? Welcome to This Explainer. Today, we're unpacking KPMG's definitive framework on corporate divestitures to reveal exactly how the most successful companies aggressively maximize their enterprise value.
Think about a relay for a second. A winning team is built long before they ever step onto the track on race day, right? The athletes are chosen through constant performance tracking. They're rehearsing every conceivable scenario. Well, the exact same logic applies to corporate divestitures. Winning corporate teams, they don't just sit around waiting for a buyer to knock on the door. No way. They're tracking performance, they're analyzing their portfolio, and they're building those value creation muscles during business-as-usual operations, way before a deal is ever officially announced. So, to get us to the finish line, here's our race plan. We'll cover training for the relay, choosing your race plan, knowing your buyer, the multiple arbitrage advantage, and finally, executing a flawless handoff. All right, let's dive into step 1, training for the relay, focusing on portfolio preparation. Now, the absolute most critical preparation happens before the starting gun even fires. If a company waits until they've officially decided to sell a business unit to figure out how it actually operates on its own, yeah, they've already lost. To avoid this, management needs a single, undeniable source of truth. It's known as a shadow P&L. By overlying full cost allocations, corporates can simulate a business unit's true standalone performance. Doing this proactively, like 18 to 24 months before buyer outreach, is literally the ultimate training tracker. It exposes whether an asset is a self-sustaining value driver or if it's secretly being propped up by corporate subsidies from the center. It's the ultimate tool for making that tough keep versus divest decision. But you might be wondering, how often should we actually be checking these metrics? You definitely don't want to destabilize your business units with constant existential reviews, right? The source material recommends a dual-speed approach. On one hand, you do quarterly, light-touch monitoring, checking financial health and operational KPIs just to maintain stability. But on the other hand, you conduct an annual, deep-dive strategic review. And this is where you challenge the best owner status. You have to ask those hard, forward-looking questions. Does this asset still belong in our future? Are we truly the best parent company to unlock its full potential? This cadence perfectly balances day-to-day operational stability with serious strategic agility.
Moving on to part 2, choosing your race plan and mapping out your carve-out strategy.
So once you know your portfolio inside and out, it's time to choose your operational pace. Every relay requires a specific pace, and every carve-out requires a specific operational model. There are 4 primary options here. First up is the business in a box. This is an explosive sprint, a fully autonomous unit with entirely separate people, processes, and technology. It's super clean, but it's expensive to set up. Next is the partial standalone. This is where only the core functions are carved out while relying on the parent company for things like IT or HR temporarily. Then you have the synthetic standalone. This is a much more conservative pace where only the financials are separated, but the operations remain heavily integrated with the parent. And finally, there's integrated with RemainCo, where you essentially stay at the back of the pack initially with minimal upfront separation, saving all your energy for a really hard sprint to the finish line right before the sale.
Which brings us to part 3, knowing your buyer so you can adapt that pace. How you actually choose your pace? Well, a good coach reads the race and adapts based on who they're running against. In our case, the carve-out strategy has to dynamically adapt based on who is standing at the finish line holding the checkbook. See, private equity buyers and corporate strategic buyers have vastly different appetites. Private equity firms generally lack existing corporate infrastructure. Because of this, they heavily prefer the clean-cut, business-in-a-box or those partial standalone models. They want an asset that can operate completely independently on day one. Conversely, corporate strategic buyers already have their own HR, IT, and finance departments set up, so they often favor the synthetic standalone or integrated setups because it allows for a quicker close and lets them immediately capture synergies by just plugging the carved-out asset directly into their existing corporate machinery. Okay, part 4, the multiple arbitrage advantage. This is all about maximizing value.
Now we're rounding the final turn into the most crucial phase of the race, the financial magic. Understanding how exit multiples work is exactly how smart sellers aggressively maximize their enterprise value. Say your business unit typically sells for a multiple of 10 to 20 times its EBITDA, its earnings. That means for every single dollar of recurring operational costs you can permanently strip out of the Carveco before the sale, you aren't just saving $1. You are actively multiplying the final exit price by 10 to 20 times. That is massive. But of course, those costs don't just magically disappear, right? They often get left behind in the parent company, what we call RemainCo, as stranded costs. But here's the secret to this incredible financial leverage. It typically only costs about 1 to 2 times that dollar to fix those stranded costs back at RemainCo through one-off restructuring. Think severance packages or breaking vendor contracts. You're basically trading a massive recurring payoff for a relatively minor one-time fee. When you do the math on that, you are left with an absolutely incredible 8 to 19x arbitrage spread. Sellers should absolutely accept higher one-off restructuring costs in their own parent company if it means delivering a highly optimized, higher margin asset to the buyer. This kind of aggressive EBITDA cleaning is exactly what transforms a standard transaction into a highly lucrative, full potential carve-out. It's a real game changer. And finally, part 5, executing a flawless handoff for the final sprint. All of this brilliant strategy, it means absolutely nothing if you drop the baton at the very end. In a carve-out, a dropped baton looks like poor data, a lack of day one readiness, or losing your key leaders. A clean exchange requires absolute clarity on roles, systems, and crucially, talent retention. You need aligned incentives to keep your best runners focused and engaged. And a major part of this execution excellence involves transitional service agreements, or TSAs. Winning teams treat TSAs as tape, not glue. They are meant to be temporary fixes with disciplined, clear exit plans designed right from day one, ensuring the new company doesn't get permanently stuck to its former parent. When that handoff is perfectly executed, this is what the finish line looks like. It's not just about offloading an asset. It's about ensuring that both the newly independent CarveCo and the original RemainCo keep running at full speed, completely unhindered by the separation. Both sides cross the finish line structurally and financially stronger than when they started. Which leaves us with one final, vital question to consider today. Based on what we've just unpacked, take a hard look at your own organization. Do you possess the objective data, those shadow P&Ls, and the strategic readiness to predict your buyer and optimize your multiples? Ultimately, is your portfolio truly ready for the starting gun? Thanks so much for joining us for this explainer, and we will see you next time.